Hello, in this lecture we're going to continue on our discussion of supply, talking about items that will shift the supply curve. So here's our graph. We've got the upward sloping supply, we've got the downward sloping demand. They meet in the middle at equilibrium. We are now concentrating on supply, specifically those items that will then shift the supply curve. Best way to do that is to take a look at examples that will shift the supply curve. Remember that we talked about the relationship between price and quantity. That's what the supply curve is. We're talking about a change in price, what will happen to the output with a change in price. As price goes up, firms are willing to produce more. In this case, if the price goes up, firms are willing to produce more pizza in this case. Remember, the concept is that the company is not setting the price, they're price takers within a market, and therefore the market price is going up, and they don't have control over the price in this case. Now, if there was a technology improvement, meaning there was some type of technology that increased the level of pizza that can be produced, now something has been changed other than price. What will that do to supply? It's going to shift it. So something other than price happens, therefore that's a shift to the entire supply curve, and that means that at any given price, for example at this given price, we are now willing to supply more. The suppliers are now willing to supply more. We could think of that as an individual firm willing to supply more. We could think of it as a market total. Either way, we can see that Q1, the quantity of pizza, has now increased. Technology is going to be an item that will increase or shift the supply. When we think about this shift, this is a shift outward. You can probably think of it as a good shift, meaning we're going to produce more at any given price. We're able to produce more at any given price. It can seem like it's going to be something bad because it's actually below. So you can see this S2 is below S1. So we can start to say, well, that doesn't look good, and just because it's below it, but it's actually a good shift. It's the shift to the right, and if you analyze the graph, you'll see that fairly quickly by saying, let's pick a price, any price, and see where we are here in terms of quantity produced, and then see where we are here in terms of quantity produced, and you'll see that the line that's going to be to the right means that we're producing more, so that's kind of good most of the time. So now we're going to say that if input prices decrease, this is going to be another item that will shift the supply to the right, meaning input prices in the case of pizza, something like cheese. If the value of cheese or the price of cheese went down, well, now more pizza can then be produced at the same cost. What's that going to do to the quantity produced? That's going to increase the quantity produced in a similar way. What's another thing that's going to shift the supply curve? We can talk about taxes. So if taxes and regulations, if those go down, if we actually reduced taxes and regulations are a cost within the production of pizza. Therefore, we're going to have this same shift where we go to S1 to S2. Any given price, we're willing to produce more because basically the costs have gone down. Now, this isn't to advocate the decrease in tax or the increase in taxes. There are other reasons for taxes, but it is something to consider when making those types of choices. Now, obviously, the reverse is true as well. So the reverse of what we just said is true. I'm not going to go over technology because I'm kind of assuming technology will hopefully continue to improve. Hopefully, we're not going to go into the dark ages where technology goes down. It could happen in certain cases, but I'm going to assume technology is going to increase, and we'll take a look at the input price in cheese. If the price of cheese goes up in terms of us making our pizza, well, now the opposite, of course, is going to happen. We're going to shift out to the left. What that means is we were at this point producing at this quantity at this same price level. We are now producing less. And so it makes sense when we look at the graph, but because S2 is on top, oftentimes people tend to think that that is going to be a better situation or a situation where we'd be producing more. And that's not the case. And if we look at it, we can see that that's what happened here. We started here producing at Q1, and this shift to the left caused us to move to Q2. So at the same price level, we're producing less. So just remember that if the supply curve shifts to the right, that means that quantity will go up. If it shifts to the left, that means that the quantity will go down, inputs being a major factor. Same for the taxes. If taxes then increased, taxes then go up, and we were at P1 here, well, that means it's going to cost more. So then for any given price, we were willing to produce at Q1 here. Now we're going to produce at this intersection Q2 here. Quantity of pizzas has then gone down because of the increase in the cost due to taxes or regulations in that case. Other couple factors that will affect the shifting of the supply curve could be opportunity cost. Remember, when we're thinking about costs, we're thinking about taxes, we're thinking about dollar amounts, we're thinking about the cost of the inputs, the cost of cheese. We can think about the cost of a lot of other inputs like wages and those types of things. We're talking about actual dollar amounts, but we have to also consider other costs. Any cost it should be included in terms of economic terms. Opportunity cost being the cost of some other option we could have had. For example, if the machine we had made could also make sandwiches, and for whatever reason sandwiches are now more in demand than they were in the past, we have a change in opportunity cost, and that could cause us to change behavior in terms of how much pizza we're going to make. Expectations also are going to be things that if we're expecting something to happen in the future, that could shift the supply curve in the present as well.